going to get, okay, so this week was, we had two events that were affecting the stock market this week. We had NVIDIA earnings. Everyone was waiting for that. That came out on Wednesday. And on today, we had a Fed speech. And and those two things, we mentioned last week that if there's any hint that they would raise interest rates more, that's bad for the stock market usually. And we didn't know if NVIDIA, if they posted a good or bad quarter, how that would affect the stock market. So there's an adage in the stock market, buying the rumor, selling the news. And there was really good earnings by NVIDIA on the 23rd. Hold on for 1 second. Okay, there were really good earnings for NVIDIA this Wednesday. And the stock initially rose after the earnings the night before, and then it basically closed flat for the day. And now it's down today, which is interesting because that was a buy in a rumor, sell in a news. Everyone was expecting really good earnings, and they came out with good earnings. And we're going to go over NVIDIA later on. It's becoming a very, very, very hard stock to value because their earnings keep getting they're getting better earnings all the time, and their PE ratio is all over the place. No one has the correct PE ratio now for the stock, and it's really hard to value. So I guess what you have to do is you have to trust in it that the company has a product that's in high demand, and it'll continue. We'll go over that later on, but that was the big news for Wednesday. So because the market didn't rally on that really good news, that's an indication that there's more focus being put on the interest rate situation. So today we had, let me see, I'll show you the Yahoo Finance news. Yahoo Finance is one of the best places for news. They always have the best commentary and best articles, and it's free. Powell says Fed prepared to raise rates further to bring inflation down. So right now, with inflation, we're at 3.13% or something like that, 3.18%, and the Fed wants to get inflation down to 2%. That's their target. And in order to do that, they're going to raise interest rates. And that usually whenever there's news like this, the stock market sells off. That's what it initially did, but I'm surprised it's up today. So anything that any companies that need to borrow money, the high PE ratio stocks, the stocks that aren't profitable, those kind of stocks usually take a hit with this kind of news. But today, I guess, let's look at the S&P 500. The S&P 500, let's look at the Stochastics. Okay. You can see we're at 31 on Stochastics. So we were oversold last Friday, totally oversold. And we were at the bottom of the channel. And towards the middle of the week, we started recovering, and we're like 30% towards the top of being overbought. But we're still at the bottom of this channel. We haven't broken through. We have a lot of major stocks like Apple, Facebook, that are breaking through this bottom part of the channel, leading us to believe that the market leaders, that the S&P might follow, because this is the bad time seasonally of the year. But right now we're actually holding at the bottom of this range. So there's hope that we could continue this uptrend in the S&P. Almost every stock follows the S&P in one way or another. Right now, the problem is we're losing momentum. We look at our chart here. Let's see, hold on. If we look at our, this this link right here gives us the number of stocks, S&P stocks above the 50-day moving average. It was up to 80% a month ago. Now it's going down every week. It went down another 4% to 29%. So we're definitely losing momentum. Fear is coming into the market. This the Fed did not help that. Fed said we're prepared to raise interest rates further. That's bad for the market. And the 10-year and 2-year are continuing to go up. That is bad because if you get a risk-free return of 5 to 6 to 7%, that reduces the demand for stocks. So the farther these go up, the worse it is for stocks. All right, so here's our talking points. Let's look at our calendar, what we have to look forward to. We have a holiday coming up. We have September 4th. Okay, so we have a little respite there where we're probably going to have a good market September 1st through 4th, maybe the 5th. But we still have, August being one of the worst months. September is actually one of the worst months too. But we do have end of quarter window dressing in September to look forward to. And we know usually the Christmas time and after New Year's, everyone's in good spirits. So we're always looking forward to the end of year rally. But the biggest crashes in the stock market happened in October. So, and we know seasonality-wise, August, September are bad months, and we just have to remember that and don't expect too much gains during those months. Okay, what other talking points do we have here? Okay, we're oversold. We're not that super oversold now. We're 31 out of 100, so we're still oversold. We have definitive Fed statements now that they're going to raise rates and hold rates higher for longer. So that's not good for the stock market going up. And we have the U.S. dollar strengthening now. So that's bad for stocks that do business overseas. So you'll see probably if the dollar keeps on going up, you can see the dollar index. Hold on, right there. It's been going down until the end of August. Until the middle of this month. But you can see we're starting to break this trend, and that's going to be bad for stocks when they start reporting their earnings next quarter. All right, so what else we have going on here? We're still in a bad seasonality, bad times of the month. August, September are bad. And then October, believe it or not, even though it's some of the worst crashes in history happened in October, it's a good month. And towards the end of the month, we expect a good stock market. Let's look at the, okay, so we're oversold right now. And we're just bouncing along the bottom part of this channel. If we break through this, right now we've broken through these two 20-day and 50-day moving average, and we still have this 100-day, which is green. And a lot of times those are like circuit breakers for the stock market. A lot of algorithms, they use these moving averages as a time to buy because it's a natural level of support. Okay, let's look at oil hasn't changed in price. We have inflation currently at 3.18%, and the Fed wants to get it to 2%. So U.S. dollar index is going up. So that means it went up 1%. So it's starting to go up, and that's due to the monetary policy. Now the gold, it basically is up just a little bit, but there's no real need or flight to quality at this time. Okay, so fear greed index, we're now fearful, and this is we're starting into a time when people are going to start throwing some stocks away that are good stocks. And once we get to extreme fear, that's when we're going to start looking around for the stocks going down in integers that are going down like 5-10% on a day to see if there's anything being thrown out with with the good stocks. But yeah, we're fearful now, and next step is extreme fear. We talked about the VIX is basically it's flat since last week. It's not really going anywhere. It's still low, but we're starting to enter fear, and we had all these reasons before that the stock market could correct, like China real estate problems, Fitch downgrade of U.S. debt. I'm thinking that could be why we have the U.S. Treasuries going up every week, because less people wanting to buy the Treasuries at the auction. That means higher Treasury rates. So this Fitch downgrade could be really something that causes a big correction in stocks. NVIDIA earnings, they actually were better than expected, but they're selling off on the news. So this AI stock bubble could be starting to be pricked, and that could be causing us, a correction. Consumer debt, it keeps getting worse. We have delinquencies all over the place, and credit cards and other ways of borrowing money. So that could be another crisis.
Specifically car loans. There's a lot of evidence that car prices have gone up quite a bit, and the car loan delinquencies are starting to go up. And I think new loans are not being issued as much.
Oh man. Okay, so this is
the rates have gotten really high, and the prices of the cars, both new and used, have gone up a lot. I guess.
So we not only have a consumer that's buckling, they're using credit to pay for all the inflation that's going on, and they're getting into debt, and things are going up in price. And so the interest rates are going up. We know that. The Fed said today that they're going to raise interest rates more. So that's going to even hurt the car market. When you borrow money to buy a car, you borrow money for credit cards. Everyone's maxed out. So there could be a credit event. I mean, all these things we're bringing up here. There could be where banks start writing down all kinds of bad loans, and that whenever they start pre-announcing bad loans or commercial real estate defaults, something where it could be rolling around the bank. I think every crisis that we've had where we went down, major crisis, is debt related. So we're starting to see this little cracks of debt. We follow a lot of stocks that don't need the debt market, and because of that, they're kind of immune from a lot of the survival issues that other companies have. But there's a lot of companies refinancing that are going to have problems refinancing at higher rates. So borrowing money is like a big part of the stock market, and we got to really understand that and stay away from stocks that borrow too much money. You see, all right. So these are all potential things. Let's see if any of those come true. But they say the black swans are the ones you don't even think are going to happen, and it's not on your radar. But we'll see. We'll keep our eyes on these issues for now. I wrote some more breaks in trend. Meta has been on a tear this year, up over 200%, and it just started this week just to break out of this channel. So we had Apple break out first, last week, and this week we see Meta, and the S&P is actually holding in there. It's not breaking out of its channel. But whenever you have this, a break out of that upward channel, you have potential of, selling off, and the more of these, and we have lots of momentum. There's a good chance we're going to have a correction. Because basically we don't have a whole lot of earnings increases for a majority of S&P stocks. So there's a good chance we're just going to be going sideways. And this break here, it means we might be going into a sideways pattern, something like that, while the interest rates continue to go up or whatever. All right, so we'll monitor some more breaks and trends. We still have this dollar. It broke its downtrend for the longest time. Now it's starting to go up again. It went up more this week. This is the big news for today. It's the Federal Reserve said they're prepared to raise rates further. Oh man. This unknown further, the word further, rates further, which they didn't say one time, two times. They basically are just gonna. This is what they said last time, but this usually makes the stock market, whenever there's an unknown, when it's not known how much they're going to raise the rates, the stock market doesn't like uncertainty. The stock market likes certainty, and if you don't provide the stock market certainty, it has a tendency not to have confidence and give stocks, and they allow stocks to go up. Okay, so we had a earnings report from NVIDIA, and NVIDIA is one of the largest companies in America now. And they're I tried to figure out how much it's worth, what its true value is. It's really hard because no one has a real idea of their PE ratio. They keep coming out with better and better earnings, and they can't keep up with it. We might have to wait 2 or 3 weeks in order for the PE to update and the growth rates. So I did my best, but there's a couple articles on how to value NVIDIA. It's not easy. So let me see. So they had better than expected earnings. They have a product called, they had a product for AI chips, a GPU for AI purposes, and it's off the charts, the demand for that product. What everyone's saying is that it's unknown how many years or months they're going to have this 80% market share for this product, because there's all kinds of competition coming in. And so I'm going to go over that later on. But right now, there's a lot of companies that could benefit from NVIDIA's high demand for these chips. And they're saying that the big tech stocks like Google and Meta, Microsoft, Amazon, Apple, they're primed to benefit from that because they have partnerships with NVIDIA for some of the cloud offerings, and Snowflake, VMware, they all have deals with them. So it looks like there's NVIDIA, even though they're selling off today, it looks like they're becoming a market leader. I tried to do my best to understand. You can see from this year to next year, this is just off the charts. It's like 314% growth. The only problem, and that's pretty amazing, but the problem with that is they don't know how long that's going to last. And you can see from the further we go out, the ranges of 45% growth next year, and then 14%, and then 20%. So if they're actually, let's say if we toss this 314% out, it's around 45% if you average everything in. And their PE is 60, then their PEG ratio is 1.5. But, and maybe in a week or two, these numbers will be upgraded, and then the PE will be updated, and then it'll be on sale again. It'll be like a PEG ratio of 1. So it's really hard to value NVIDIA because they keep growing, and there's an unknown amount of demand for their chips going forward. So what I did is I looked at their valuation measures. They're one of the 5 or so $1 trillion companies now. The forward PE is 60, according to Yahoo, and the PEG ratio is 2.54. So according to Yahoo, they're growing at like 150% a year. Is that right? No. If their PEG ratio is 2.54, they're only growing at 25%. They're only growing their earnings at 25%. So, but their profit margin is really good. It's above our 13% that we want, and return on equity is 18. That's pretty good too. So I looked at what Morningstar said and CFRA said about NVIDIA. So Morningstar said they have a fair value. They're basically fairly valued. They're trading at what their value is. So they mentioned that. Let's look at what CFRA says. They're overvalued by 40%. So that was disconcerting. So it's and we looked at their earnings over the years, and it's pretty inconsistent. You can see that they didn't really have a niche until this year, and they've been selling like graphic cards, and maybe last year they were selling server like chips for the data center, and all of a sudden they have this product that's off the charts and it's growing at 300%. So you can see that Warren Buffett wouldn't really be interested in this because it's really easy to displace chip companies. Chip companies don't stay on top for very long. For instance, Intel was the dominant chip maker in the 70s and the 80s and 90s, for instance, and now they're not anymore. And you can see their PE ratio is much more expensive over the past couple of years. It's been growing. It used to be 16, 15. Now it's like 80, and there's some places that even say it's 300 PE. But the return on equity, it's pretty much all over the place. A lot of times, if you demand, if you have a price to where they're at, they have to improve their efficiencies, and return on equity should be like 44, for this kind of price. But they're growing 300% between this year and next year. And here's an article. Yeah, it's really hard. My summary for this is it's really hard to determine a fair value. This is what CFRA said about NVIDIA. They said our buy view reflects our optimism surrounding growth. The emergence of generative AI is creating an unprecedented demand for NVIDIA's GPUs, which are considered to be the primary building blocks for large language models and are driving permanent changes in infrastructure. The one thing that's different between NVIDIA and AMD and any other company that makes chips for this purpose is NVIDIA has like a software solution. They have this kit that you can actually build your models around their software, and the other companies don't. And once you started in that environment, you can't like go to another CPU or another GPU quickly. So that's the niche that they have. But how long would they be able to maintain that 80% market share? Let me see. So the software opportunities being created by NVIDIA, for instance, the software for the AI, that increases the demand for their GPUs. But they can't sell in China right now a lot of the things that they want to because of export restrictions. So that's kind of the China exposure. Yeah, that could be a problem because they can't sell some of the things to China they want to. Okay, so Bank of America, I looked at their PE ratio that they had. They said it was 245. So you have all these numbers all over the place. No one can keep up with, what the true value of the stock is. So it's kind of, it's right now, it's really iffy, until they, we know Microsoft, no one's going to come out with a new version of Office that's better than that in the next couple of years. But for chips, it's really easy to get, for Intel, for instance, to be taken off its perch, and it's a very competitive industry. I don't think Warren Buffett would be interested in NVIDIA. That was a good exercise. Okay. You can see that, try to make this a little bit bigger. Okay, you can see that the S&P is at the bottom of its range. We have it well-defined channel defined in black, and the top and the bottom of the chart. You can see that we're oversold at 31. So truly oversold was last week at this time, and that was down around 7 in the stochastics. We like to buy whenever the low on the stochastics match the low on the boundaries of our chart. And let's look at every other ETF. We have very similar pattern. We have around 31 on the stochastics, and we're at the bottom of this channel. So the great thing about that is we're in a well-defined uptrend, and we're holding at the bottom of this channel on the face of bad news. Today we had bad news with the Fed, so we have to respect these channels and know that we're oversold, and we have fear gripping the market right now. All right, so let's the defense, aerospace and defense bull, DFEN is basically flat. It's been range bound all year long. Gold shares are also flat, going sideways. And they're oversold. We like to review stochastics every month or so, just so we can review how to go about the process of defining when you buy a short term. Short term meaning if I have $100 or if I have $1,000 to invest, and I only have maybe one stock to buy, I want to make sure I buy at a time that would give me the best price near term. So if you're in a trend where you're making higher highs, higher lows, and you're within a well-defined channel, you want to buy when it's closer to the bottom of the channel and not buy when it's at the top of the channel. It goes counter to what a normal investor would feel emotional wise. If it's going up, you want to keep buying it. If it's going down, you want to get rid of it. So then you want to think the opposite way. All right, so let's look at the materials. XLB, we're basically right in the middle of our well-established sideways pattern. That could be related to the dollar going up now. As the dollar goes up, the prices of commodities go down. And let's look at the XLC. Okay, these are stocks in the communication sector, such as Facebook and AT&T, Verizon. It's an established uptrend, and we're basically at the bottom part of this channel right now, and we're still oversold. XLB, healthcare. Most of the dividend-paying sectors are sideways now. They're basically not appreciating in value, and they're not growing a whole lot. The XLI is it's an established uptrend. It's oversold, and it's halfway between the channel right now. Let's look at the XLP. The XLP is touching the bottom of its range between the black lines, and we're oversold. And the financial sector, XLF, they are oversold and halfway between the channel, the black channel lines. This is interesting. The XLU, it's in a downtrend, primarily because the utilities have less of a demand whenever treasury rates are 5 at 6%. And who's going to take a risk on buying a stock that yields 3% or 4% when there's treasuries, the guaranteed investment paying 5 to 6%. And the real estate is going LXLRE. It's another downtrend, and it's down because interest rates go up, the affordability of houses go down, and XLE is going sideways. So we're in a sideways pattern, an XLE, the energy. And this is the Brazil ETF, EWZ. It's paying like a 13% dividend, and it is in a well-defined range, right in the middle of its range right now. Uranium is sideways throughout this year, and it's well defined in these ranges. Let's look at some of the stocks we're following. AbbVie is in a well-defined sideways pattern. It's in the middle of the pattern now, and it is oversold. And Abbott Laboratories is the same chart, basically. It's oversold and basically halfway between the black channel lines. Alibaba hasn't gone anywhere in a year. It's sideways. It's surprising because it's a growth stock, but it's being held back by rules the Chinese are putting on stocks, it seems. Alphabet, one of the strongest charts that we have and we're following, is actually still within the boundaries of its uptrend. And it could benefit from some of the AI hype, and it could be hurt by the same thing if the AI hype doesn't pan out. Let's look at the Altria Group. It's been a well-defined pattern. It pays 8% dividend, and it is basically going sideways, like a lot of the dividend stocks. Amazon is in a true uptrend. It is at the bottom end of its range. The next stop for Amazon is up here. It seems, and it's oversold. Apple broke out of its super 40% run this year, and it is hugging the 100-day moving average, which is green. So it's right at its 100-day moving average, and it's in a technical downtrend right now. It's making lower highs, lower lows. I'm owning it as a long-term hold. I'm buying and holding it forever because I believe in the story and the power that a $2.7 trillion company has, and I believe in their products because I use them every day. Let's look at AT&T. They're in a downtrend right now. This pattern follows Verizon, and it's basically going sideways for the last couple of years, and it hasn't appreciated a whole lot. It has a lot of debt, and that's affecting their earnings, and they might have to reduce their dividend. We'll watch for that. Bristol Myers Squibb, they are in a downtrend. Their earnings, they're not projected to grow anytime soon, and if you could project out a couple of years, their earnings are scheduled to go down in 3 years, from 3 years to 4 years. That's why it's not a growth stock anymore. It's only a dividend stock until some of their drugs are realized that are in the pipeline. Colgate-Palmolive, it is a very, very well-established sideways pattern. They're a dividend stock, and very consistent demand in this kind of environment. They're oversold right now, and they're at the bottom of their channel. CSX is a dividend-paying stock, and they're oversold and halfway between the black lines. JP Morgan is in an uptrend. I think they benefited from the crisis of the banks earlier this year, and they are investing heavily into tech. So I've bought and held this stock for a long time, and they pay a dividend, and they are the largest bank in America. All right, Meta Platforms. You can see that Meta actually just jumped out of their channel. And they're oversold. But let's hope that Meta resumes its uptrend and continues its higher highs, higher lows. This is one of the best performing stocks this year. And sometimes just a little jump out of this range could establish a new downtrend. Let's hope not. But I'm buying it and holding it because I believe that they're very creative and they're very profitable, and they can come up with new products very easily. Microsoft, they're at the bottom part of their channel right here, and they're oversold. They're like halfway between oversold and overbought. So let me see. Pepsi, they're in an uptrend right now, but they basically broke out of their long-term 2-year uptrend, and now they're basically starting to go down. And we're starting to make a new trend line for them going down. I've held this for like 13 years, so I really believe in the stock. It's more of a dividend stock for me, but it's been growing consistently around 7 to 10% a year. Procter & Gamble, it's one of the dividend-paying stocks that we're following, and it's basically sideways for the last year. And it's a well-established pattern, and they're at the top of their range, and they're oversold. And let me see. Verizon, this is very similar to AT&T stock. They are in a downtrend, and it looks like they're losing market share to T-Mobile, like AT&T is. And they might have to cut their dividend, so we're going to watch out for that too. Visa is in an uptrend. This matches the chart of MasterCard. You can see they're at the bottom of their channel, and they're basically halfway between overbought and oversold. So this is like a it's great that they're still in the channel and they haven't broken out of that. So I think they do well in this kind of environment because they don't take any of the risk of the consumer defaulting on what they can pay for their credit cards. Waste Management is a dividend-paying stock. It is going sideways all year, and it's at the bottom end of their range, and they're oversold. So once it gets down to the bottom part here, that could be a good time to look at if you're interested in that. They're they're kind of a stock that you can buy and hold for a long time, because over time the economy in America is growing, and it's and the amount of trash that the people of America make goes up every year, regardless of how good the economy does. So that's like that's why I own it. Amgen, it's a drug stock, and it's at the top end of its range right now. It's in a sideways pattern, and it's overbought. And CVS is starting a new trend sideways. It seems like CVS, when it purchased a healthcare company, they got themselves into they're like an in-between middleman when they're selling prescription drugs, and they lost a big contract in California, and it seems like there's a lot of competition in this, and Warren Buffett would look at this and say, well, there's no moat, there's no guarantee that in 5-10 years they're going to sell the same products that they are selling now, because prescriptions, there's a lot of different business models for companies to get prescriptions to their clients. So see, Johnson & Johnson is going sideways. It's dividend-paying stock. They just spun out part of their company, Kenvue. And Walmart is an uptrend. You see, and they're one of the few retail stocks this week and this month that are actually doing really good. Most retail stocks like Foot Locker and other related companies, they're doing bad because of shrinkage, and that means people stealing from them and losing inventory due to things falling off a truck, whatever. But Dollar Tree had a problem with that this time, and there's just a lot of problems in retail right now. I don't have a whole lot of retail, only maybe one stock that is involved in retail. Tractor Supply is basically sideways pattern for this whole year. It used to be going up it broke its uptrend right here, and it's turned into a sideways stock. Berkshire Hathaway is making higher highs, and it's oversold right now. It's a unique company that not a lot of analysts understand. It's really hard to put your head around this company, and because there's so many moving parts in companies that we can't value it like a PE ratio like other companies in growth rates. They just have their own business model. MasterCard, this chart is very similar to Visa. They are doing really well, and they're pretty much overbought right now, and they're at the bottom of their range. Let me see. Tesla. There's an article that came out today on Tesla that Dan Ives was saying Tesla has a huge opportunity with the charging network, that they can make $20 billion with the Ford and GM partnerships that they set up. So whenever I heard that news, I said this is becoming a energy company, and it could be, that part of the business could be bigger than selling cars. That hasn't shown up in numbers yet, but I'm still waiting. Dan Ives said today that he thinks that they're going to make a lot of money on the charging network. So that's what makes me excited about this. They're at the bottom of this channel, and they're pretty much oversold, starting to come up. NVIDIA is the best performing stock this year that we're following. We had blowout earnings today, or Wednesday, but their stock is down today, but it's amazing how much they're growing. It's really hard to value them. And you see, Nike it's kind of they're hugging the bottom part of the chart of the uptrend, and they're oversold. They went down a lot recently because of related companies like Foot Locker having problems in retail sales. And the good thing about Nike is a lot of their sales are moving to online and direct to consumer. So there's a trend there, and hopefully as that trend continues, they'll make more money. Ford is at the bottom of its range. They're not growing anymore, and they're oversold. It's not a growth story. It's more of a dividend-paying stock, and they have a lot of competition. They're being undercut in price by Tesla, and they're not profitable in making their cars yet. So they need to ramp up the production before they can be profitable. And we have Upstart. It had an AI hype earlier this year, but now that it's kind of fizzling out. Fiserv is in an uptrend, and it's at the bottom end of its range, oversold. Costco is still in a sideways pattern, and T-Mobile is going sideways too. It was in an uptrend all last year, but now it's basically taking a break. That is the review of Stochastics. Okay, we're going to go over some of the market movers. First of all, it looks like we have some energy stocks. We have Devon Energy. We have Valero. Oil must be up today. We have a lot of software companies. Autodesk. Tesla is a software company. Let me see. Intuit. And we have some of the antivirus companies doing good today. The ones doing the worst are AI-related stocks. We have NVIDIA leading the stocks going down for AI. And we have interest rate sensitive stocks like Pulte Group. We have a lot of the home builders going down because as you raise interest rates, the cost of buying a house goes up. So we have, what are stocks here? AI related stocks are going down. Let's look at the NASDAQ. you can see that Marvell Technologies, they're an AI provider. They do components for chips. We have NVIDIA. We have Meta, which is an AI stock. Broadcom, AI stock. So it's very surprising that NVIDIA is going down, but it was a buying a rumor, selling a news event. Let's look at some of the stocks doing good. These are all software stocks, a lot of them. Workday software, Intuit. We have Autodesk, Atlassian. They do make Jira. CrowdStrike, and they're antivirus company. All right, so the Adobe is a software company. So we have a lot of software-related stocks. A lot of stocks doing best today are dividend-paying stocks. And the ones doing the worst, most of the stocks in the Dow are going up today. All right. So it's very surprising that seeing that the Fed decided to raise rates, decided to keep rates higher and longer and raise more, that the stock market would be up. But we are at a spot in the stochastics where we have support. Okay, let's look at some more of the news that's on Yahoo Finance. Okay, well, we can see from just in the sector ETFs. Let's sort by stocks going up the most and the worst. The ones going up the most are energy stocks, and followed by healthcare and technology. And healthcare pay a high dividend. Consumer discretionary, they pay a high dividend. So we have, and energy stocks pay a dividend. So these are all dividend-related stocks. The ones doing the worst are the ones that are affected by the U.S. dollar going up. So we saw the U.S. dollar is appreciating, then all the material like stocks like gold have a tendency to go down as the U.S. dollar goes up. Now let's look at the home builder. These are all regional banking. These are all affected by the interest rates. As the interest rates go up, regional banks have problems, and home builder have problems because the demand for housing. And I think the semiconductors are down with the NVIDIA sell-off. All right, so let's look at more about the S&P 500. Let's look at more news from CNBC. Okay, so this kind of news usually tanks the market, but we're up. So perhaps people were expecting the Fed chair to say they're going to raise rates further, and then the stock market rallied on that news. We've been selling off for the last week or so. So it could be a buy on rumor, sell on the news, or the other way around for this Fed meeting. And you see what other news we have here. Okay. We can see that the U.S. 10-year is flat today. It's not going up. That's a good sign. NVIDIA is recovering. I'm expecting NVIDIA to go up after a really good earnings report. But we have the biggest market movers down and up are, we already went over that. Okay. So what else can we see from the stock market? Let's go look at our stochastics. We like to do this every month or so, just so we can train ourselves when to buy and when to sell stocks. Right now, the indexes are mostly following at the bottom end of the channel. So we expect, if they're following this channel, that they're going to bounce and go to the top of this channel. Let's hope that the stocks that are breaking the channel go back and go up of the channel. I'm an optimist. I like to assume the stock market's going up. And I guess when you're investing, you always have to have some kind of sense of optimism. Otherwise, you always sell out when the stock market goes down. Okay, so you can see that we're halfway between overbought and oversold, and the majority of these indexes we're following. And we're at the bottom of the channel, and we're at a bad part of the year, seasonality-wise. Let's see what other things we have. Let me see. Okay, looks like we're bouncing off of our key level in the S&P 500 right here, and we're actually bouncing up some. So we're still in an oversold state. We're at 31 out of 100. When it gets to be 80, we're overbought. And when it gets below 20, we're super oversold. Right now, we're just recovering a little bit. So it looks like what else is happening here? Okay, this is a good time to review. It's a good time to review some of our basics for investing in the stock market. Okay, so here's some of what makes a good growth stock for a buy and hold. We like to look for high free cash flow, annual earnings increasing in a straight line, projected for many years to come. PEG ratio around 1, or if it's greater than 1, it has to be a really consistent company. And if it's below 1, that means it's undervalued, usually. Return on equity of greater than 10, and we can find all these in Yahoo Finance. So if we're looking at a stock in Yahoo Finance, we can look for a stock. Look at Apple. Okay, let's look at the statistics. Okay, so you can see on this place right here, the PE of the stock, the PEG ratio, that gives you an idea how much it's overvalued. We like to see the profit margin. For Apple, it's 24%. That's double of the 13 we're looking for. Return on equity is 160. We like more than 13, so that's over the top, really good. And we like to see a dividend, and the total debt is 109 billion, and they have total cash of 62 billion. You subtract those, and they have 62 billion in debt, and that's really small compared to their market cap of 2.7 trillion. And they pay a dividend. We like to see forward annual dividend is 0.5%. That's not that great, but it adds to the total return. Those are the basic things we look for in a stock. We like to see a company that has a competitive edge. For Apple, that competitive edge is they have an installed user base of over 1 billion customers. They have an ecosystem where people have their information on their phones and their music, and they have services revenue that's around 30% of their total revenue, and that is growing. So it's very consistent, and we like that's one of the competitive edges that Apple has, and they have a very high user retaining. They have 90% satisfaction, and people keep buying their phones as they come up. We like a dividend. We like highly transparent and predictable growth streams, little or no debt, and company has good management and a good plan for growing the company. And so what I do when I invest is I put, when I start a position, I put 0.5%. That's less than 1% in a company as the first position. So I start there, and I hope the stock goes down. And you keep track of your thesis that you had whenever you invested in the company. So, for instance, if my thesis is that a stock will be a leader in an industry, I'm going to keep track of that. And whenever it's proven that they're not a leader and they're losing market share and they're not going to survive, then at that point in time, you have to decide to get out of the stock. Another thing is I try to buy the stock when the stochastics are near or below 20, which is when they're oversold. And if it goes down 15% from where I first purchased, I buy a little bit more. And that's called dollar cost averaging. And you have to put a certain portion in different categories whenever you're investing. If you're very conservative, then you put some in fixed income and bonds. I like the idea of having a certain percent. I have 40% in dividend-related stocks that pay around 3 or 4% dividend, and I have a good portion in high growth stocks that are growing at 10 to 20%. And then I have a couple starting positions, which I described with my 0.5% approach. That's how I invest. You have to come up with your own plan that you like the best. I think that's all I had to say for now. I thank you for your patience and with today, and hope you have a good weekend. Okay, talk to you later. Bye.